Bill Fleckenstein is a veteran short seller and president and founder of Fleckenstein Capital. He closed his 13-year-old bear market fund last year because valuations made it, in his words, too dangerous to bet on more losses. Bill joins us now from Seattle with his perspective and to find out what he is betting on now. Bill, welcome to Bloomberg News.
Oh, thanks for having me.
Tell us what some of the warning signs you saw were. When you say that it was just too dangerous, some harsh words. What were you seeing?
First of all, let me be clear. I never said it was too dangerous because valuations were so low. I thought it was too dangerous because I knew the Federal Reserve was going to continue to engage in copious, if not reckless, amounts of money printing, and I knew that there would be massive stimulus applied from a fiscal policy standpoint, and I also felt that there might be a bounce in the economy because things had gone so far in one direction. So there was a variety of reasons that I did that. It was not because valuations were absurdly low. I mean, a lot of stocks got quite cheap, but it wasn't that generically stocks were that attractive.
Do you think this so-called money printing is behind the recent rally that we're seeing?
I do. There is some amount of economic activity that was a rebound from how stretched we'd gone on the downside, and inventory restocking and other parts of the world have picked up. So some of it is legitimate, but some of it is sort of a false dawn created by money printing. And I don't think that, even though, for instance, the leading economic indicators are up 4 months in a row and would ordinarily mean we were going to have the recession was over and we're going to have an economic recovery, I think in this case money printing has warped that, and maybe the economy is not going to get worse for a while, but we're not going to start creating jobs. We're not going to see the things that normally we see when we, quote unquote, come out of recession. Bill,
when you closed your fund, you were looking for more flexibility. You have since opened another fund. Tell us about that.
Well, I was a short-only fund, and so people that had money with me looked to me to capitalize on the downside, and I was a piece of their strategy. I did not want that narrow, specific responsibility anymore because, A, I thought it was too dangerous to do that for a while, and a lot of the collapse that I was expecting due to the bubble had occurred. So I started a new fund where I have the flexibility to be long, short, neither, both, whatever I felt was appropriate.
And you are quick to point out that you don't think that short sellers were responsible for this. You think that the banks were reckless, correct?
Oh, absolutely. It wasn't the banks that were reckless. The Fed was reckless. The regulators didn't do their jobs. The banks, the guys running these banks were complete idiots. They leveraged themselves up 20, 40, 50 to 1 with paper they couldn't even value, all based on the notion that S&P and Moody's said the paper was AAA because housing prices were never going to go down. I mean, to have missed the scope of the credit bubble and the real estate bubble is inexcusable if you're going to call yourself a professional. And to run a financial institution that way and still be running it, if you had to go to the government and get aid, is ridiculous. Those guys should have all been fired.
Bill, you like precious metals and related industries. Tell us why.
Well, if we're going to see money printing here and elsewhere, so-called quantitative easing and other measures, then I think I know that leads to weaker currencies. It ultimately, not tomorrow, will lead to more inflation. And there are businesses or industries or niche companies that benefit more by money printing. And as opposed to, if you thought the economy was going to recover, you'd look for beneficiaries of the economic cycle. But I'm not so sure we're going to get a real economic recovery. We may just be headed towards some variation of stagflation, in which case you want to own a different kind of asset than you do if you thought you were legitimately coming out of recession. So precious metals are beneficiaries. Some companies that explore for precious metals, some service companies, other businesses like that, where if we get more weakness, we'll get more money printing. So I want to capitalize on the money printing, not the economic activity.
Bill, we have about 30 seconds left. Taking a look at the overall economic climate, you're a firm believer that the next shoe to drop is going to be Social Security. Is that because the trust fund's running out of money?
Well, I don't know that that's the next shoe to drop. That is a big shoe that will drop. And based on the economic activity weakness and the terrific story that was in Fortune magazine that I recently wrote about, I think that it's going to be something we're going to have to talk about maybe as early as next year, and it's a huge problem.
Bill Fleckenstein of Fleckenstein Capital joining us this afternoon. Bill, thank you very much for your comments. We appreciate it.
Thank you for having me.